Well, welcome to Equity Valuation, Concepts and Basic Tools. We're going to go through our models of how to value equities. And first, we'll start off real easy here. When the market price is less than the estimated value by the analyst, then the asset is undervalued. And if the market price is greater than the estimated value, we say the asset is overvalued. So for security valuation to be profitable, it must be misvalued. The security must be misvalued, but also it's got to converge towards its intrinsic value in the future for you to get extra returns for being right about the fact that it's misvalued. And we think the market price is more likely to be correct when a security is followed by many analysts, going back to our thoughts about market efficiency and efficient market prices. So what types of valuation models are we going to look at here? Well, our primary model for valuing equities is a discounted cash flow model. And here the estimated value of the security is just the present value of its future cash distributions, that is, the expected dividends on out through infinity. And this is our dividend discount model, a special case of a discounted cash flow model, where the cash flows we're modeling with are expected future dividends. We could also look at the future cash flow available to shareholders. Say we're trying to value a security that doesn't currently pay dividends. We can look at its free cash flow to equity instead of dividends. It's kind of our proxy for the dividends the firm could pay. Our second type is multiplier models here. Now, our cash flow models are what I would call absolute valuation models. We've looked at expected cash flows, we've estimated the appropriate discount rate given the risk of the security, uncertainty about the future dividends, and taken the present value. With multiplier models, it's more of a relative valuation model. We're looking at how a security is valued relative to other securities with similar characteristics. We could also look at an enterprise value multiplier, which is the ratio of its enterprise value, which we'll define here shortly, to sales, or to EBITDA, earnings before interest, taxes, dividends, and amortization. Our third type is an asset-based valuation model, where the equity value is equal to the total asset values of all the firm's assets minus its liabilities and the value of its preferred stock, its preferred equity. And we'll use that mainly for a company that's going into liquidation. Because typically we know, at least any successful company, has a market value that's greater than the net value of its assets. We need to talk a little bit about types of dividends here. When we talk about cash dividends, these are cash payments made to shareholders, and we can have regular dividends or special dividends, sometimes called extra dividends. Not extra special dividends, either extra or special dividends. The thing with regular dividends is there's the expectation that the firm will be able to continue to pay those over time. And over time, hopefully, they'll increase their regular dividends as the earnings power of the firm increases. Now, stock dividends, on the other hand, are paid in shares of stock, not cash. So an example would be a 10% stock dividend. If you had 100 shares, you'd get 10 more shares, you'd get 110 shares. A stock split is a very similar proposition, but it's just on a little larger multiplier. Here our example, if we have a 2-for-1 stock split, if you have 100 shares, you'll get another 100, so that'll increase your holdings. A reverse stock split, on the other hand, reduces your number of shares that each investor holds. So with a reverse 1-for-5 stock split, your 100 shares, old shares, would turn into 20 new shares. Now, none of these affect the value of the whole firm, and since you're getting a proportional increase or decrease in the number of shares, each investor's proportional holding of the whole firm is unchanged. So this doesn't change the value. So even with a 2-for-1 stock split, we'd expect the price to fall in half. So your 100 shares might turn into 200 shares, but because the price falls in half, twice as many shares outstanding. There's no change in investor wealth from these stock dividends or stock splits. Share repurchases, we want you to consider those as an alternative way to return cash to common shareholders. Now, there may be tax advantages. Sometimes the tax rate on capital gains, your gains from selling the shares, is less than the tax rate on dividends. And in this case, there's a tax advantage to repurchasing shares to put money back in equity holders' hands as opposed to paying dividends. Sometimes share repurchases are taken as a signal to shareholders that management believes shares are undervalued. That's why the firm's buying back its own shares. And share repurchases are also used to offset an increase in shares outstanding when employees exercise their incentive stock options. So they exercise their options, the firm has to issue more shares, and so so they can issue more shares to come up with those shares to honor the exercise of the options. Let's take a look at our dividend payment chronology. The first date to concern ourselves with is the declaration date. This is the board has met. They've decided what the next quarterly dividend or annual dividend is going to be, and they announce it. That's the declaration date. Now let's look next at the holder of record date. They have to decide, well, we got to pick a day and send these dividends to everybody who owns the stock on that particular day because shareholders and share ownership changes from day to day. So here, our holder of record date is September 17th. So everybody who owns the stock on September 17th will get this dividend, and it'll be paid on the payment date. Here is September 30th. Okay. So at the time the dividend is declared, investors are told that. The declaration says, well, we're going to pay a dividend of 37 cents per common share to holders of record on September 17th, and these dividends will be paid on September 30th. Now, the ex-dividend date is the first day that the stock trades without the dividend. And the reason is because of the settlement period. So this will be 1 or 2 business days, depending on the settlement period. In our example here, say that was 2 days. And if this is 2 days, it's because the settlement period is 3 days. So if you entered your trade on September 15th with 3-day settlement, you would own that stock on September 18th, so you'd still get the dividend. So if this is the ex-dividend date, it means you buy it on September 15th, you don't get the dividend because with 3-day settlement, you wouldn't be a holder of record until September 18th. So day before, you buy the stock on the 14th, you get the dividend. You buy it on the 15th, you don't get the dividend. So we expect the share price to fall by about the amount of the dividend from the close on the 14th to open trading on the 15th. So let's look at some present value models here. We're going to value a common stock with a multiple year holding period. This is really just kind of a warm-up calculation. We're assuming we know the price some years from now. Of course, if we knew the price some years from now, that would really help in our stock selection and relative valuation. So PN here is the assumed sales price immediately after this nth dividend is paid. So here we're just saying, given our required rate of return on equity, which is the appropriate discount rate here, we take the present value of all the dividends, and then immediately after DN is paid, we're going to sell the stock for PN. So we take the present value of all those cash flows, and that's the value of our shares. So let's look at valuing a common stock with some numbers here. Stock paid a $1.50 dividend last year. So that's D0 in our notation. And it will grow at 8% every year. Well, that's our G. That's our growth rate. You require a 12% return. That's our required return on this equity, so we're going to use that as our discount rate. And we expect the stock price to be $51 at the end of year 3. So what's the stock value today? Well, let's take the present value of all these. Now, one thing to be careful of is because this was D0, our model, we really want D1 here. So we grow it for one period at 8%. 8% is the rate we're assuming dividends grow each year. So we've got D1 over 1 plus our required rate of return there. So that's the present value of the first dividend to be received 1 year from now. And then we've got our second dividend, so we grow it at 8% again, and that's D2, and we discount that for 2 periods. And then we've got D3, same idea. Dividend grows at 8%, discount it for 3 periods, and then our PN, our final price, we sell it. And so that is at time 3, right after that dividend is paid, we sell it for 51. So that is also discounted for 3 periods. So that D3 and this final value of the stock received at time 3, we discount both of those for 3 periods, and we get a value for the stock, $40.50. Here's our general dividend discount model, and this one goes to infinity. This is all the future dividends, and so this just says sum up the present values. So for each dividend, D1 discounted for 1 period, D2 discounted for 2 periods, on and on. So we're assuming the corporation has an indefinite life, and the investor must receive future cash dividends to be willing to invest today. He's investing based on the value of the future expected cash dividends. With the free cash flow to equity model, we're just putting the free cash flow each period in place of the dividend. Remember, I said free cash flow to equity is our kind of estimate of what the firm could pay as dividends if they were paying dividends. So that's cash available after a firm meets its debt requirements and the necessary capital expenditures to keep the firm operating and growing at the assumed growth rate. So you could think of this as the operating cash flow minus the investment in fixed capital plus any net borrowing on the debt side. So here's the rationale. It reflects the firm's capacity to pay dividends. It's useful for firms that aren't currently paying a dividend, and the analyst doesn't have to project the amount and timing of future dividend payments. Usually we just have a single growth rate for the free cash flow to equity over time. Now, preferred stock valuation is real easy. Preferred stock usually pays a fixed dividend and has no maturity date. So it goes on forever. So we can just divide that preferred dividend by the required rate of return on that preferred stock. You may remember we saw this back in quant too, as the present value of a perpetuity. The constant growth model, which is a dividend growth model, just assumes that everything's going to grow at a constant rate G. And we'll see, and we have seen at various times, that this constant growth rate G here is the return on equity times the retention rate, 1 minus the dividend payout ratio. So let's go through an example. And this is going to be similar to the one we did with the sale at the end of 3 periods at time 3. Except we're going to value the infinite series of dividends here. So this stock paid $1.50 a share last year. That's still D0. We've got our same expected rate of return, required rate of return, which is going to be our discount rate. And, oh, sorry, that's G. Here's our required discount rate right here. If I could read, I would have known that. And so we're going to value the stock today. So first off, we turn D0 into D1, multiplying by 1 plus that growth rate. Now, be aware, whenever you're looking at problems, if it says paid last year, recently paid, anything like that, that's D0. If it says will pay, is expected to pay this year, or they're fixing to pay this year, as they say in Texas, then that's D1 and you don't have to grow that. But remember, you have to start with D1, the dividend expected 1 year from now. And then we divide by the required rate of return minus this constant growth rate. Now, clearly the constant growth rate has to be less than the required rate of return for this to give us a sensible answer. So if we plug all this in, we get $40.50, same as we got before. And why is that? Well, we rigged it a little. That sale price on our earlier example was the price at time t, the value at time t, of all the future dividends. So in this case, we're just discounting all the future dividends. So we're really looking at an infinite series here, but its value converges. As long as G is less than K, it converges to a particular amount. As we go further and further and further out in time, we get closer and closer and closer to $40.50 as the present value of all the dividends. So remember, that's D0. Estimating the value of G. Well, this is the retention rate, and here's our return on equity. The idea here is a simple example. If our return on equity is 10% and our dividend payout ratio is 50%, that means we're retaining 50%. Well, then the firm will grow at 5%. We've got 10% growth of equity every year, but we're paying half of that back in dividends. That's our payout ratio. And so the growth rate of the firm would be 50% times 10%, a constant 5% over time. Now, we could have a multi-stage model because we've got to be able to model firms that are having fast growth right now. Okay? There's always some companies that are in new industries, new products, or they just figured out how to do something better than anybody else, and so they're growing faster than their forever growth rate. So we're going to model this by having the dividends increase at a rapid rate, but at some point they've got to go to a constant rate over time. Whether you're talking about personal computers back in the day, well, the adoption was huge and they just had great growth rates. And then at some point, personal computers, desktop computers, turned into more of a commodity product. You just had to buy them just like you would copiers or anything else like that. And so the growth rate should settle down to about the same growth rate as the overall economy at some point. That's the logic behind this multi-stage dividend discount model. So let's do an example of that and see how it relates to what we've done already. So we've got a stock, last year's dividend. Well, remember, we've got D0. We're going to have to grow that. It's going to grow at 15% for 2 years. That's our period of fast growth. And then it will grow at 5% after 2 years, forever. And the required rate of return is 11%. So fast growth slows to normal forever growth, required rate of return, D0, and those are the pieces of the puzzle. So step 1, forecast the dividend for each year of rapid growth. Well, we said it was going to increase at 15% for 2 years, and D0 was $1. So our first dividend is expected to be $1.15. We grow that at 15%. Second dividend expected to be $1.32. And we said after that, the dividends will grow at 5% a year. So D3, we take that, here's our D2 value there. We grow it at 5%, and that's D3. Now, in order to use the constant growth model, we have to plug in a dividend that will grow at a constant rate forever, so we can divide it by K minus G. Now, you see in the CFA curriculum, they often say, plug this one in. Well, I'm suggesting that you identify the first dividend that will grow at a constant rate. Not the one that has grown at a constant rate, but this. Certainly that $1.32 is the result of 2 periods of 15% growth. But when we say what's going to happen to it in the future, we say that $1.32, it's going to grow at 5% forever. And that really cuts one step out of your calculations. Mathematically, it's exactly the same. We could value every dividend for 10 years and then apply the formula to get the present value of all the dividends from dividend 11 on out in time forever. We've still accounted for all the dividends. Mathematically, it's the same. There may be some differences associated with rounding. So let's try and identify the first dividend that will grow forever and use that in our constant growth model. So here's step 2. Use the constant growth model to find the value of the stock 1 period before the dividend that will grow at a constant rate. Because when we discount these dividends, we're going back 1 period. So we're going to use price time 1 price, okay, value, to D2 over K minus G. Now remember, this is our $1.32 dividend, the one that will grow at a constant rate of 5% forever. And so when we apply that formula, we get a value 1 period before D2. Just like with that constant growth model, the Gordon growth model, we plugged in D1 over K minus G to get the value of the stock. So we're getting a time 0 value plugging in D1. So if we wait to use that constant growth model here, and we're going to wait until we have dividend 2, that's going to give us the value 1 period before dividend 2 is paid, so a time 1 value. So right after, okay, D1 is paid, we can value it based on D2, and that's why we get a time 1 value here of $22. But we still have a dividend to account for, don't we? We haven't accounted for that first dividend. We accounted for D2 through D infinity, but we still need to take the present value of this first dividend, so we've accounted for them all. And when we do that, we get $1.15 plus $22, right? Get the first dividend at time 1, sell it for $22 immediately after, based on the constant growth valuation formula. Add those two together, divide by 1 plus our required rate of return, and we get $20.86. Now, as I said, we could have applied the constant growth model to D3. We could have waited. It doesn't change anything mathematically. And so here's what that looks like. There's a little rounding in the dividends, but it's the same thing. So here we said, okay, we take the present value of the first dividend, present value of the second, and immediately at time 2, right after that second dividend, we sell it for the present value of D3 through D infinity. That's what we get by applying the constant growth model to D3. We get a time 2 value. So here's the way you might often see it in the textbooks. But as we saw, we can get the same answer by using the constant growth model on the first dividend that will grow at the constant growth rate. This is the second dividend at the constant growth rate, our D3. So what about using this dividend discount model? Well, it's most appropriate for firms that pay a dividend, so that shouldn't come as a shocking result. So we need the first one that we need a dividend that will grow at a constant rate. So a stable, mature firm, non-cyclical firms, okay, might be most appropriate for those. The two-stage dividend discount model are fast growth and then slowing growth, firms with high current growth that will fall to a stable rate in the future, just as we modeled it. Or for older firms that were in the constant growth phase, but now are in a high growth phase or are losing market share. We could have a three-stage dividend discount model. If for a young firm that was still in the high growth phase, we may project 30% rate of growth for 3 years and then 20% rate of growth for 2 more years, and then settling down to a constant growth rate after that. There's no change in the mathematics. Whatever dividends we have, however we've modeled dividend growth, we take the present value of each one until we get to one that will grow at a constant rate forever. So whatever happens before that, if the dividends were $1 and $1.50 and then $1.75 and then $3 and then $2 and then that will grow at a constant rate forever, take the present value of those expected dividends until you can apply the constant growth model, and that takes the present value of all the future dividends past that using our dn over k minus g formula. Now, we've had our discounted cash flow models, mainly dividend discount model in this case, but we talked about a free cash flow to equity valuation model as well. What about price multiples? Well, this is relative valuation. We're going to look, it's like they do house valuations, right? They want to value your house. They look at what similar houses in the recent time period in the same neighborhood have sold for. We're not saying whether that's overvalued or undervalued. We're just saying this is what they sell for in the current market. So it's really relative to the sales of other houses. You may adjust for the number of bathrooms or the square feet or whatever, some differences. But that's the idea. Okay. Well, the common price multiples that are used for this relative valuation are PE ratios. You always hear, okay, well, the market's trading at a PE of 19. That's historically high. Or you see an analyst report that says, you know, this company's just as good as this other company, but it's trading at 12 times earnings, and this other company is trading at 15 times earnings. So that's the idea, is comparing it to something else. Besides price to earnings, we could use price to cash flow ratios, we could use price to sales ratios, or price to book value ratios. These are certainly the four most commonly used. And don't think you have to use just one of these. You can look at all these valuation metrics to see how an individual security is priced in the market relative to other similar securities, relative to a peer group, relative to its industry group, or relative to the overall market. So what are the advantages? Well, we know they're widely used, they're readily available, and they're certainly easy to calculate. If we have the price and the earnings, if we can divide, we've got it. So those multiples can be historical or forward-looking. So note that. Sometimes we'll look at price earnings as current price over the trailing 4 quarters earnings. That's our P0 over E0. And that's an historical one. Now really, theoretically, what we care about is future earnings, not past earnings. So we may look at the current price to the expected earnings over the next 12 months. The trouble is, those have to be forecast. The last 4 earnings, subject to any revisions, we know exactly what they were. So that's kind of the trade-off there. And these can be used for cross-sectional between companies or time series analysis. We can look at how many times earnings a company is traded at over time. We can plot its PE over time. Maybe it's at the high end of its range. Maybe it tends to vary around a trend value. Maybe that'll help with your security selection. And all these multiples are associated with equity returns. Company that experiences higher growth is going to have a higher price-earnings ratio, other things equal. So where can we get a PE? Well, we can get a PE just by going into the marketplace. But we can also develop a PE based on fundamentals, and we're going to use this constant growth value valuation, this formula, the Gordon growth model. And so what we're saying here is, what would the PE be if this stock were priced at its constant growth value? So we start with that constant growth value, and then we're just going to divide each side of that equation by E1, expected earnings. Well, we get on the left our forward-looking price-earnings ratio, just what we're looking for, P0 over E1. And notice the numerator of our constant growth formula is now D1 over E1. That's simply the dividend payout ratio. That's the percentage of the expected earnings over the next 12 months that we expect to be paid out as dividends. And so we might call this the leading price-earnings ratio. What are the primary determinants of a PE ratio? Well, the required rate of return. If it's riskier and K, our required rate of return is higher, then that price-earnings ratio is going to be lower, our fundamental, based on fundamentals PE ratio. How about G? Well, higher G, that reduces our denominator there. And so two companies otherwise the same, one with a higher growth rate is going to have a higher PE. Investors are willing to pay more per each dollar of earnings when those earnings are expected to grow more rapidly in the future. So these are really the same factors that affect a stock's price, that affect its PE ratio. So other things equal, higher dividend payout ratio, higher dividend growth rate, or lower required return. This is our comparative statics. We're looking at just partial changes. So we're saying, what if we changed this and didn't change anything else? What if growth went up, nothing else changed? What if the dividend payout ratio went up, nothing else changed? So that's all fine, and it's good to understand these, but note that these are interrelated. Because if a firm pays out more in dividends, returns more, then that's going to slow its growth. And so higher dividend payout tends to increase the PE. Lower growth tends to decrease the PE. So we don't know really what the overall outcome of that is. And that'll differ for different companies in different circumstances. And that's what this note at the bottom is getting at. Note that increasing the payout ratio will decrease the growth rate. And so we can't just go to a company and say, you know, all you have to do to raise your stock price and your PE ratio is to increase your dividends. Well, no. To the extent that's going to slow its growth, we don't know whether that's going to overall increase or decrease the value of these shares. So let's look at a PE based on fundamentals. The math is, of course, pretty easy. Even financial analysts can do it. You expect a firm to pay out 30% of its earnings as dividends. There's our payout ratio. Earnings and dividends are expected to grow at a constant rate of 6%. There's our G. There's our payout ratio. Here's our K. And it's pretty straightforward from there. Our PE based on fundamentals, we expect it to sell for 4.3 times expected earnings, next year's expected earnings, E1. So here's some price multiples. We spoke of these before, didn't define them. Stock price over earnings per share, stock price over sales per share, book value per share from the balance sheet, shareholders statement of shareholders' equity actually, or price to cash flow per share, where cash flow is operating cash flow, or it could be what we defined as free cash flow per share. So how do we use those? Well, it's based on what we say, the law of one price. If two firms are comparable or two assets are comparable, they should sell for the same multiple. So if we have a PE or price-sales ratio or whichever ratio lower than the industry average, or a comparable stock, or a peer group of stocks that you've constructed for comparison purposes, that would suggest that the stock is undervalued. I mentioned this term enterprise value before, and the fact that in relative valuation often we use the enterprise value to EBITDA, or EBITDA, as our valuation metric there. And this we look at in firm acquisitions. A lot of times they'll say, well, in this industry, how much times enterprise value are people paying for when they acquire a company? So that enterprise value is the market value of all the common stock outstanding. So there's your market cap. And the value of debt. We're not going to subtract the value of debt here because the value of the debt claims and the value of the equity claims, that's the total value of all the ownership claims and liability claims to the firm. And then we're going to take out cash and short-term investments. Why are we subtracting that out? Well, we're going to subtract that out because we're kind of looking at what a firm would be able to, what a firm would have to pay, okay, to buy all the common stock and all the debt of a firm and take it over that way. But once they owned the whole firm, they'd get their hands on that cash and short-term investments. So their total cost of the acquisition will be what they paid for the stock, what they paid for the debt, minus the cash and short-term investments the company owns that they could lay claim to after the acquisition was complete. So that EV represents the total market value of the firm, and EBITDA is the total earnings to both debt and equity. Because remember, that's earnings before interest and taxes. So we're a little further up the income statement there. And so that's total earnings to debt and equity because we haven't taken out the payments to we haven't taken out the payments to debt, our interest expense on our income statement yet. And when are these useful? Well, if firms have different capital structure, because we've taken the debt effects out of there, we might have two firms, one is 40% debt and one is 30% funded by debt. Well, how do we compare those with ending numbers? Well, we're going up a little further on the income statement to this EBITDA, as I mentioned. And so that allows us to compare these multiples for two firms, even when those firms don't have the same capital structure. They don't have the same debt to assets or debt to equity ratio. And we can also use this when earnings are negative. And when the PE ratio with negative earnings, well, it becomes negative and it also becomes kind of nonsensical and doesn't really fit our uses. So we can use this enterprise value multiple even for a firm that temporarily, we hope, has negative earnings per share. Let's look at an example just to crunch some numbers here. We've got a stock price of 40 with 200,000 shares outstanding. The market value of the long-term debt is 600,000. The book value of the long-term debt is 900,000. The book value of total debt and liabilities is $2,000,001. The firm has cash and marketable securities worth $250,000, and our EBITDA is $1 million. So let's look at some of the issues involved in crunching these numbers and getting an enterprise value multiple. So the first step, determine the market value of short-term debt and liabilities. Well, we assume that market value and book value are close for short-term debt items, right? The values of them, the present values of them, don't change that much with changes in interest rates. So we know the book value of short-term debt is the book value of total debt minus the book value of long-term debt. Well, we're given that book value of long-term debt is $900,000 here, so we can subtract that off total debt, and that must be our book value of short-term debt. And because it's short-term, we can use the book value. For our longer-term debt, we really need to use the market value because it can differ more from the book value of the debt. Remember, the book value of our debt is the value of the liability when we issued the debt. When market interest rates change, the market value, what it would really cost to settle that liability, can be significantly different than that book value, the initial value of the liability when we took on the debt. So step two, we want the market value of total debt. So we want the market value of long-term debt, and that was given to us as $600,000. And we have our short-term debt, which we just calculated as $1,000,002. So there's our total debt value there. And our third step, market value of equity, well, that's the most straightforward so far, I think. Stock price times the number of shares outstanding, so that's 8 million. So we've got the market value of equity, we've got the debt, and we've got the short-term securities. So step 4 is to calculate the enterprise value. We take total debt plus total equity minus cash and short-term liquid investments, and we get an EV of 9.55 million. And now we divide that by our EBITDA and say, well, this firm's trading at an enterprise multiple of 9.6. And then we do our relative stuff, comparing it to a competitor, or a peer group average, or an industry average. And a low value indicates that it may be underpriced. Now, asset-based models, in those, the equity equals the market or fair value of assets minus liabilities. Now, that's not to say that it's easy to value the assets of a firm. How do you look and go, oh, this firm's in fiber optics. What's their factory worth? Well, gosh, that's as hard as any of the other problems we've run up against, unless there's some sort of market data, some trading going on in such assets. Analysts usually adjust book values to market values on asset-based models. We're concerned with the current market value of their assets, not the historical depreciated cost values. And asset-based valuation models provide, and you may want to put the word can in there, can provide a floor value. Something you'll notice with companies, when we value their assets, if things go wrong in that industry, and does it provide a floor? Well, no, because if that industry's profitability goes down for whatever reason, those assets specific to that industry, their values are going to go down as well. So asset-based models, they really give us a liquidation value at a point in time, or at least that's what we're trying to estimate with these asset-based models. So let's compare these models. Present value models, what are the advantages? Well, they're theoretically correct, and they're widely accepted. The disadvantages, the inputs must be estimated. All our future cash flows or all the future dividends forever have to be estimated. And your valuations, if you start fooling around with those and start tweaking G just a little bit, that can have a huge impact, or let's say a very significant impact on the valuation you come up with. So we estimate the inputs with error, and our results are very sensitive to our inputs. That's the trouble with present value models, or the dividend discount model, or free cash flow models in particular. Multiplier models, what are the advantages? Well, they're widely used and accepted. They're associated with stock returns, according to some studies. They're easily calculated and readily available. And, well, let's just say, according to the curriculum and for the exam, they're good for identifying attractive companies and useful for time series or cross-sectional analysis. Some of the disadvantages, well, if we have differences in accounting methods, the comparisons are problematic. So we have to adjust for differences in accounting methods and then look at our multiples. And multiples for cyclical companies can be highly variable. Think of, well, automobile manufacturers are often highly cyclical companies. And so at peak earnings, they may be selling at low price earnings because as they approach the peak, well, now earnings are going to go down into a recession cycle, maybe even negative. And so at the trough of the recession, when things are expected to be better on average in the future, they may be selling at very high PE ratios when they're at their lowest earnings and lowest prices. Asset-based models can provide floor values useful for a firm with mostly tangible short-term assets or if it's to be liquidated. I mentioned that it makes sense for a firm that's to be liquidated. What kind of firms have mostly tangible short-term assets? Well, financial firms. Financial firms have their assets typically short term. And what does that mean? That means our book values or our stated market values for those financial assets, we're pretty confident about those compared to trying to value a production line or a factory or a producing mine or something like that. The disadvantages, ongoing firm value may be greater than asset value. Well, that's why we're using them in liquidation. Certainly, if you take the assets of a Microsoft and look at the earning power of Microsoft, well, the earning power makes the stock price way higher than just the fair value of the net assets per share. And as I've mentioned for sure, fair values of assets can be difficult to estimate. And with primarily intangible assets, could be even more difficult than a factory or something like that to say, oh, well, let's value this patent. Well, that can be a pretty tricky business. So how do we choose a valuation model? Well, what are your available inputs? And how are you going to use this valuation? So if we're going to use it for liquidation, maybe we want to look at asset values. More complexity is not better. I mean, it looks fancier, but it's not necessarily better. So who says we have to pick a method? Why can't we look at the relative valuation across 4 metrics? Well, we can. You should consider values using more than one method. And when they differ, start to wonder and inquire and do some analysis to determine why. Why is this firm cheap on a price-to-sales basis but seems expensive on a price-to-earnings basis? Consider the uncertainty about your input values. And instead of using a fancy model and saying, here is the price should be $50.17, you'd be best to do a little sensitivity analysis to your inputs and look at a range of values and say, well, I'm 90% sure that the intrinsic value of these shares is in this range right now. And consider uncertainty about the appropriateness of the model that you're using. So if we're using a PE model, it's a cyclical firm, maybe you should consider that's not the most appropriate measure to use. So that wraps up our valuation stuff for equities. I hope you got a lot out of this, and we'll see you down the road in the next volume somewhere.